Okay, so today what we are going to learn is it is the most basic of stock market, that is the fundamental analysis. So fundamental analysis is basically identifying the proper potential of that company based on their balance sheet and other auditing reports. Fine. Is this clear to you? Okay. So in fundamental analysis, when we start analyzing the companies, as you might have heard this before, that companies can be classified based on their market capitalization, and even sector wise or industry wise capitalization can be done based on what business they are doing. So here we are going to see analysis of companies and classification based on capitalization. And what is capitalization? Capitalization is total number of stocks available of that company multiplied by the current market price. Whatever the market price is of the stock, that into total available stocks of the company. Okay, this is capitalization. So we have three categories: large cap, mid cap and small cap. So according to me, large cap is those companies whose market capitalization is above 1 lakh crores. Fine. And mid cap are those between 1000 crores to 1 lakh crores, not above 1 lakh crores. And small cap will be less than 1000. Yeah, these are the three simple classification based on capitalization. Okay. So now let's see the next thing. First thing that we are going to say is price to book value. Now what is book value? Do you have any idea? What is a book value? Okay, not in detail. So what you know about that? I am asking you, what do you know about it? Book value. Just tell me what is a book value according to you, if you know a little bit about that. No, okay. So book value is already measured by the auditing department of each company, and a book value is a value which will be given to each shareholders if the company is closed for each share. Is it clear to you what is a book value? Okay, the minimum amount, the amount which a company will be issuing to the shareholders if the company gets closed is known as book value. So price to book value is nothing but current market price divided by the book value which is already given. Is that price to book value clear to you? Okay, it is also called as PB ratio. You have heard, you might have heard about it. What is PB ratio? PB ratio भी बोलते हैं इसको. So normally when a stock is less than 2 in book value, price to book value, मतलब PB ratio अगर 2 से नीचे है, then the stock is considered undervalued stock. Okay, मतलब उसमें potential है, that stock has more potential to grow, but its value is undervalued right now. Okay, if it is less than 2. But when you see price to book value or PB ratio less than 2, it is time to get little cautious. because such thing happen in two cases. Either there might be some issue with the fundamental, or the whatever balance sheet they have issued, there might be something wrong in that, or either you are very lucky to find a company like this. If PB ratio is greater than 5, it is an expensive stock. Okay. Between 2 to 5, it is normal. Fine. Then we have next thing is debt to equity ratio. Okay, debt to equity ratio is, you might have known this basic thing. Debt to equity ratio क्या होता है? 2 to 5 only is yes. Other than, if we see any stock which is fundamentally having price to book value over 5, then we will reject it. What these fundamental analysis will do to you is, this will help you in rejecting stocks. Basically, it will be more easy to you to reject stocks when you will be looking to go for a longer term holding or portfolio for a long term wealth creation. So you can come to the fundamental during that time and refer to these things. And if there is anything which is about negative about the company or something, we will simply reject the stock. We don't want to keep such stocks. Is it clear? Less than 2 is an undervalued stock. Matlab, that means the real price of the stock is less than the price. No, it is not to be rejected. It is something to be accepted. Less than 2. Undervalued stock is like the real price might be something around 1000, and now the stock will be trading around 200. That kind of stocks are undervalued, and the real price of stock should be only 200 or 300, but the stock price is 1000, 2000. That is overvalued and expensive stock. So we don't buy such stocks. Okay. So next thing is debt to equity ratio. Debt to equity ratio is what? It actually indicates that how much debt paying capacity does a company is having. Means that is the interest coverage ratio, but debt to equity ratio is total debt of the company and total assets and the liabilities and all those things what the company has as their asset or equity is debt to equity ratio. So how we will do is, total debt of the company is divided by the total equity of that company. This, yeah, it should be less than 1. You just remember that debt to equity ratio should be less than 1. You understood, right? What is debt to equity ratio? Total debt of that company divided by total asset or equity that company has is debt to equity ratio, and it should be less than 1. Is it clear? Debt to equity ratio. Shall we move to the next? Okay. Next is interest coverage ratio. That means how much, for how many years a company has the interest repayment source with them, so that they can repay their loan amount or interest for how many years a company is having. So greater than 3 years or greater than 3 is a very good company. Is this clear? Interest coverage ratio. This is a simple thing. Is it clear? Interest coverage ratio, or you want me to repeat again? That I will tell you where it will be available, all these things that we will come next. First understand these basic terms. Fine. It is interest coverage ratio is simply that how much capacity this company has to pay its loan or interest payments and all those things. Fine. Now next thing is operating profit margin of 5 years. So what is operating profit margin? Operating profit margin is nothing but the total profit that the company has to operate the company other than the expenses is called as OPM, operating profit margin. Excluding all the expenses and everything, if a company has a profitable OPM, means company is having some revenue and income through their business apart from their expenses. That is OPM. And when we are looking at fundamental analysis, we see OPM of 5 years. Is this clear to you? Then this is a very clear thing, quarterly net profits. Every quarter the company announces its profits and losses. So it should be good, and we should see a steady growth in quarterly net profits. Then the next is yearly % growth in earnings per share. Okay. EPS is already given by default. We can see EPS before. That I will tell you next where to see EPS and all other things. And yearly percentage growth of 3 years can be compared by the present year's growth and last 2 years or 3 years before back growth. You can compare it in the terms of EPS. This we will discuss in practical so that you will get a more clear knowledge. Okay. The next term that we have is price to earnings multiple. This I will show you practically in this thing. Achha, we have two terms here, price to earning multiple and the same price to earning multiple is nothing but the expected growth by the market. And expected growth by the market, that how much market is expecting from a particular stock to grow, can be done by the stock's current price and that divided by the EPS. EPS will be given to us before this. Is that okay? This will be a little confusing at the start, but when I start you explaining this with the proper example, then you will know how to calculate and use this. Okay. Then we have a term called fair value multiplier. That is, first we have to find the fair value multiplier. Then we will multiply that fair value multiplier with the current stock market price to find out the proper value of the stock. Is this clear? So, fair value multiplier is nothing but yearly % growth in terms of EPS. I said we will compare the EPS for last 3 years. So last 3 years EPS compared and the growth in that divided by the PE ratio. That also we will discuss in the practical. In a few minutes we will discuss that. So fair market value, you can be PPTs will be updated in website, and I will tell you how to calculate all these things. Let me finish off with the terms. So next we have PEG ratio, PEG, that is present growth ratio, or you can call it as price earnings to growth ratio. Simply remember these terms. When PEG ratio is greater than 2, a stock is overvalued. If it is between 0 to 1, it is undervalued, and 1 to 2 is normal. Higher the PEG ratio, lower the growth. Lower PEG ratio, higher the growth. This thing, PEG ratio is a clear indication of a stock's expected growth and future growth. So these are done by a very popular and few analysts who will publish each PEG ratio and all these things. Every quarter they used to do that. Okay, we only need to know how to use this for our trading method. So fair market value based on PEG ratio will be there is a thing that we can find out proper stock value based on PEG ratio also. Some people find it out. So in this, people use this same thing in different ways also. So this is how I use this thing. Whatever the current market price is of the stock divided by PEG ratio is the fair market value as per PEG ratio. This is how few people use this. So now what I will do is, I will tell you practically when you are looking at a stock how we can find it out. So in your website, or sorry, in your desktop or laptop, you can open this thing, screener.in. Fine. And when you go to screener.in, they will ask you to sign up in screener.in, just free sign up, just do that. And here you can see enter a company name. So when you start typing for, let's search for MRF. MRF Limited is coming. You need to double click on this to open it up. So this has opened now, MRF Limited. Is it clear till now? Okay. So our first thing is capitalization greater than 1 lakh CR, 1 lakh crores is large capital company, large cap company. So what kind of company is this? This is 22,000 point something. Okay. This is mid cap. This is mid cap, right? Now we have to see price to book value. So here you have to do a little bit calculation. As you can see, the book value as 18,770.35. What we will do is, we can make a note of this. Side by side, you can also make a note of this thing, so that in future you can remember. We are comparing MRF for now. CMP I will write current market prices. Okay. So MRF current market price is, this is the current market price, 52,220.30. Write it down. Okay. This is current market price. Then market cap, just for noting which cap it is. It is a mid cap, around something 22,000 something, 22,141.41. Decimals you can omit it if you want. We don't want to be a pinpoint accurate. Okay. This is market cap of MRF. This is mid cap. Next, we have to find price to book value, also called as P by B ratio, that we will find it out as equal to CMP divided by book value, that is equal to 52,220 divided by, what is the book value of the company? 18,000 something. Here you can see book value of the company is 18,770.35. How much it is coming? Division 20.35. That is equal to 0.11. So is it a good company as per book value, undervalued, overvalued, or normal? Is this clear so far? Okay, let me calculate myself. Yeah, it is 2.78. So this comes under normal. Can we reject this stock? Shall we reject this if it is normal? No. So when should we reject a stock which is normal? I mean, when should we reject a stock, or based on what condition? More than 5. Okay. Okay. Is it clear till now? Okay. Then next we have to see debt to equity ratio, and we want it less than 1. Next is debt to equity ratio. How much it is? You can see here, debt to equity ratio. It is 0.30. So is it a good company as per debt to equity ratio? Yeah, since it is less than 1. So it is debt to equity, it is satisfying 0.30. And the next thing that we want to see in this company is interest coverage ratio, and it should be greater than 3 is preferred. The higher the better. जितना ज्यादा होगा इंटरेस्ट कवरेज रेशियो उतना बढ़िया है, कंपनी के पास इतने साल का इंटरेस्ट और लोन पेमेंट करने के लिए है। तो इंटरेस्ट कवरेज रेशियो इज 10.24. This means that this company has potential of paying their interest and debt till next 10 years. So it is an excellent company for now. So let us write this down. Interest coverage ratio, that is equal to कितना है इंटरेस्ट कवरेज रेशियो 10.34. 10.24. Okay. This is the interest coverage ratio. Please make note of this by your end also, or else you will be confused later on. Okay, great. Next we have to say is OPM, operating profit margin of last 5 years. Okay. What we have to see here is, I will tell you, you just come below this, come down to this, and in annual results you are seeing OPM here. This is the OPM row. Okay. So recently calculated is 20.73. Fine. You can see here it is a steady growth, 10, 14.456, 14.61, 21.27, 20.73. When you come and see about OPM, just see that OPM, current OPM value should be greater than this PE. Is that fine? OPM should be greater than PE, and it is greater than PE. Then let us have a look at quarterly net profits. It should have a steady growth. Again, you come down, you come to the annual results, sorry, quarterly results this time, and profit before taxes, before tax, whatever the profit is, they have shown like this, and this is the net profit. So last 3 years, if you see 415, 375, 490, there is a little bit shake in quarterly results, but it is fine. It is still growing. We don't see any negative thing in. Yeah, June 16 it is okay, 490. So next quarter, let us see how much they are issuing. It's a mixed up thing. Okay. Now this thing is a little confusing. So kind of make a proper note of this. Yearly percent growth in earnings per share over last 3 years. Fine. This we have to calculate, and this we have to see first. Then we have to get the exact growth of the company. To see the exact growth for now, how we will do this is, in annual results, you can see here EPS unadjusted, current EPS last issued unadjusted was 3646.38, and before 3 years, 1, 2, 3, it is 1345.83. So it is growing, right? Earning per share has increased. Is this okay? Just remember current. Okay, 1 second. Is it clear now? Okay. So we are talking about EPS last 3 years growth, yearly growth. So at present, current EPS is 3646.38. So let us make note of this. Yearly percent growth as per EPS for last 3 years. This will be calculated as current EPS, that is 3646.38 minus EPS which was before 3 years, 1, 2, 3, that is 1345.83. How much it is coming? So it's coming around 2300.55, right? Yeah, roughly 2300 divided by 3 to see 3 years growth. Am I right? So how much this is coming? Around something around 766.85. Is the calculation clear by now? 328. 328 is coming for what? Just a second. Yeah, it is 766 something. Okay, so now to get the proper growth, this is yearly percent growth. Till now it is clear to you, right? Now this answer divided by PE will give you last 3 years proper growth. So how much is this coming? So what is PE of this MRF, price to earnings? 14.38. So divide this answer 766.85 last 3 years EPS growth divided by current PE. So it is coming around 53.32 roughly. Am I right? So a clear view of MRF is it is growing at 53% per year, this company. So what was the expected growth of the company? Look at the PE. The PE is the expected growth by the market, 14.38. So is the company MRF growing more than the expectation of market or less than the expectation of market? More. Okay. So now this yearly percent growth and the growth of MRF is around 53% per year it is growing, and that is more than the expected market growth. So now let us come and calculate fair value multiplier. So how we can calculate fair value multiplier? It is again yearly percent growth in earnings divided by the PE. So again what you will do? You will divide this by the PE ratio, which is 14.38. So how much it is coming roughly? Is this clear to you? Fair value multiplier. We are going to divide two times of the EPS. First we divided the EPS for the P for the first time. We got the proper growth. Then we divide again by the PE and we will get the fair value multiplier. Is this clear, Arvind? Okay. This is where many people get confused. I will explain this again. You got the actual growth of the company per year is around 53%. Till here it is clear to you? Around 53% the company grown. Okay. So to calculate the fair value multiplier, you will divide this term, yearly percent growth which you got, divided by current PE, 14.38. Okay. So 53.33 divided by 14 point, what was the value? 38. Is it clear to you now? Fair value multiplier. It is around 3.7. This is the fair value multiplier. So now to find fair value of the stock, just a minute. Okay, it is not happening. Okay. Now to find fair value of the stock, what you will do is current market price multiplied by fair value, that is equal to how much? 3.7 into 52 to 20. So how much it is coming, Arvindji? So at present the stock is much low or very high than the fair value. So is it a good stock to buy? Yes, to buy. So MRF is a very good stock to buy. Is it clear now? Is the voice coming now? Is it coming now? Okay. It is not gone. I was not speaking. As we are interested in technical analysis, we would use this information with technical analysis to enter and invest in this stock. Okay, is this okay? Let's look at another stock. You want me to look at another stock or you want me to continue to the next topic? Okay, you mean the next stock or next topic? You will practice. Okay. But before going, tell me any one stock that you want to see. Tell me any name, any name you remember. You said SBI. Shall we see SBI? Shall we see? Okay. So SBI is what kind of capitalization? Which cap it comes under? No, 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 no. Check again. What is I? Large, you are saying. You are saying large cap. This is coming under large cap. Next thing that you will say is price to book value book ratio. Okay. That is, this is how much price to book? 272.05 divided by 228. How much it is? It is coming around 1.1 something. So how is this company as per price to book value? Yeah, 1.18. So how is the stock? Stock is undervalued for now. Okay. Sorry, I opened something. Okay. Interest coverage ratio is normal 1.03. Here, I think this is an issue. You can see I said stock P is 48.43. Now what is the OPM, operating margin of this one? Look at the yearly. OPM is 38. So is this good or bad OPM? OPM is decreasing. The profits of the company and the expected profit was around 48% something and it is showing 38. This is the expected profit also. Yeah, it is less. Straight away the stock will be rejected from this end itself. And now let us see something more, that is the peg ratio. Let us see. You need to type the peg ratio or the ratio which are not shown here in this one. Here it is asking enter a ratio name. So you will write peg and it will show. Then you have to double click on this. So how much is the peg ratio and how is this company as per the peg ratio? Overvalued and peg ratio is very high. Am I right? See, if it is between 0 to 1, stock is undervalued, 1 to 2, it is normal, less than 2, it is overvalued, greater than 2, sorry. So it is overvalued, peg ratio. And how much should be the debt to equity ratio? Yeah, how much should be the debt to equity ratio? It should be less than 1, debt to equity. And it is showing how much? 14.02. That means debt is more high in this. So what should we do? We should reject this or we should continue analyzing this as per fundamental. Leave this stock. So I think let us look at another stock, and this one is undervalued. I think so because I think I have checked this before. That is Idea. Okay, debt to equity is slightly higher, 1.68. Chalega par. Peg ratio is also more. No, this is also rejected. We cannot go with this. UCO Bank. You want to see UCO Bank. Acha. Uh, See here itself this stock is out. Debt to equity 24. EPS is minus. Earning per share, this is going in negative. Can you see here? Profit growth or be minus. And here you can see a section about the company and promoters and all those things. Stock is trading at 0.69 times of its book value. Okay. Company has low interest coverage ratio. Company has delivered a poor growth. Company has low return on equity. Okay. Look at this, liabilities of 66248. इतना उसके ऊपर डेप्ट है. This one. Okay, so this is a bad bank. One employee said it will go up to 130 and current price is 51. If it will go up to 130, we will catch the movement, not an issue. We will have our technical analysis thing ready. Look at this from 3 years. Look at this. Can you see from 2014 how it is being? ये ऊपर की तरफ जा रहा है कि नीचे की तरफ आ रहा है? From 3 years. Tell me. This is नीचे. So this is in a declining mode. This is the maximum time limit chart. This area was a potential buy area, like 15 rupees it was trading 2006. It went up to 60, 78. That is roughly 4 to 5 times of your money in 2 years. Okay, this and all we will learn in our technical classes. As soon as this has come at this point, at this high, I am sure we might have got some indications to sell this in technical analysis. We will discuss this. Keep note of this UCO Bank. We will discuss this in this 2008 rise. We will discuss in technical analysis part. Here we had, okay, here we had another entry at 29. Again it went rock to, sorry, this what is the price here? 143, 2010. We might have entered here. In 1 year again we have multiplied our amount 5 times, I think 29.6, thus nearly 5 times. And again we might have got some indication here at the top to sell this at 143, 145. Remember, whenever we do technical analysis and whenever we take trade, whether it's an investment or long term or short term, as soon as we see any entry or exit, sorry, we will be very cautious and we will try to exit that because we want to maintain that profits. Okay, we will be in a very much hurry to exit, and to enter we will be entering very slowly, doing our research and all those things. Okay. See, after this decline, there was no buying opportunity. It was here somewhere around here, and but when you see something happening like this in a, it is going in a range. I won't be interested to carry forward my position in this stock. Maybe above the high of this stock, we will go for the breakout trades. And again, we had a sell signal here. This is something that we will be selling off from right here. We will sell it off. Okay, so now there is one more thing that you should know, and that I will explain you in another 5 minutes. Then we will be finishing off this fundamental analysis. You can see here screens. Click on the screens. You will see so many screens. Give me a 5 minutes. Let me have some water. I will come back. How is the fundamental class till now? Wonderful. Thank you. So give me a 5 minutes time. I will come back. Let me have some water. Okay, so shall we start again? Okay, so you clicked on screens and you will see so many screens over here. Click any one. Okay, You can see here some companies are coming based on their screens. Come below. Okay, can you see here query builder? Okay, so let us filter it with our screens, that is market capitalization. You need to double click it when it comes. Okay, market capitalization greater than, one second, sorry, what kind of company you want to see? Market capitalization greater than 1 lakh, we will go. 1,000 we will go. Capitalization greater than 1,000, and you need to include this end to write the next line query. Without end it will not show up. Last line you can leave this one. Next, what shall we write? Debt to equity ratio sorry, it is not coming, one second. Debt to equity. Okay, debt to equity should be how much for a good company? Am I right? Debt to equity ratio should be less than 1. Am I right? Okay, less than 1. So what is the next thing? Interest coverage ratio. Am I right? One second. This should be equity ratio. Okay, not just equity. I think, one second. Debt to equity ratio. Okay, it is not coming. So it is debt to equity less than 1. Interest coverage ratio. Interest coverage ratio should be how much? Greater than 1 preferred. Which one? Interest coverage ratio less than 3 कैसे होगा? Greater than 3 is preferred. Yeah, it is not less than 3. So let us type greater than 3. What else we want? We will put next one as peg ratio. So here it is coming. Double click on this. Peg ratio should be how much? Less than 1, I think. Okay, peg ratio less than 1. Okay, 2. If you want, we will put 2. Okay, I'm doing one thing. I am copying this and showing you what happens if we run it without the end at the end and run this query. Can you see unknown word 3 peg ratio? And I think it is in capital, so it is showing like this. One second. And if you put end over here and unknown word to end, just a second. Acha, this is in capital, I think. That is why it is not showing. This should be in. Acha, 1 second. Run this query. Unknown word 2 and the last also it is same. I think there is no need to close this one. I think. Okay, end will not come in the last. So end will not come in the last. Okay, you are right. In the last one there was some issue. Yeah, end will not come. So based on this, we got so many stocks. Okay. So let us see one or two stocks in this, or you want to filter it out more? How can we filter this more? Tell. PEG ratio is there, interest cover ratio we have put, debt to equity is there, market capitalization we have put. What else we can use for the filter? Price to book ratio we can use it. We have not used this. Should be less than 2. Am I right? Can you see here? Yeah, OPM also you will see. Price to book value should be how much? Less than 2, I guess. 2 to 5. So shall we put here should be less than 5? Between 2 to 5 you want. Okay. So we can put here as up till 5. 5. And OPM, what filter we can use in OPM? OPM should be greater than PE. It is just PE, industry PE, price to earnings you can put. Put and with peg means what are you trying to say? And with 2 means 2 times you are saying. 2 times of price to earning it should be greater you are saying. Peg ratio less than 2. We have added this now. It is here. See. Peg ratio less than 2 we have already added. Last filter itself we added that. Peg ratio less than 2 we added. Yeah, okay. So I think this is enough for now filtering, and let me copy this. And earlier based on this filtering we had something around 25 stocks. Now we are filtering it out more to see more thing. So run this query. So here we need an end. So earlier we had some other results. Now it is showing 76 results for now. Earlier, how many results we had? We had 185 results earlier. Yeah, different companies are coming up. So now 76 is coming. So let us see this NMDC for an example, and let us see Hind Zinc also. NMDC's P is 15.45 and annual results is here. Can you see it? OPM is 38.09. It is good for now. See, look at this. Company is virtually debt free. Okay, we have some issues for growth that we will find it out. So as per our filter, yes. Okay, this is the issue. I did not tell you this. Peg ratio should not be minus. Note this point also, please. If peg ratio is minus, also that company is having poor growth. नुकसान में है, that company is going in losses actually. If peg ratio is minus 1.15. Okay, kindly make a note of this. Let me also make a note of this. Do you understand why the peg ratio should not be minus? Okay, what I said is the peg ratio, PEG ratio should not be in minus. It should not be negative. It can be less than 2, but not less than 0. Is that clear? Is it clear? Just a second. Hold on, hold on. Hold on. Is the voice clear now? Yeah, is it clear? Is the voice clear now to you? Okay, is it okay now? Is it okay now? Can you hear now, Mr. Arvind? Okay, can you hear me now? Type yes if you can. Okay, fine. So let us add this filter also to our query, as this is showing peg ratio is in minus. So company is already in a negative as per their returns are concerned, or poor results. Peg ratio gives you an idea of a company expected growth and current growth. So here you can see they might have written in the cons that company has delivered poor growth of 10.70. Fine. So let us go back to our screens and query. Select anything. I think we can add in same thing, greater than 0, less than 2. So now we have how many companies? 94 companies are showing up. Is that NMDC showing up? Let us see again. Okay, it is not showing up. NMDC is not there now, I think. Let us check any, yeah, it is out. Let us check any one. And let me see again whether if you put in separate line how many companies are showing. Okay, let us see again. Run this query. Did you see the difference? So it is better to put your query in separate line. So starting itself, I think we are getting automobile and tire companies. Let us see CET. MRF, we have already analyzed MRF, and okay, let us see Hind Zinc, as this is coming again. Kitex, by the way, is a beautiful company, Kitex Garments. Okay, so stock P, first thing that you will see is stock P is 11.57. Calculate the price to book value. Divide 1153 by 564, how much it is coming. Stock PE is 11.57. Let me see OPM. Okay, this is just fine. OPM is 12.33, so it is above PE. Fine. We have already filtered. Can you see here? Peg ratio is good. Debt to equity is good. Interest coverage ratio is good. Okay. So what is price to book value of this company? CET Limited. It is current market price 1153.90 divided by 564.58. It is around 2.04. So it is undervalued or overvalued stock for now. It is a normal stock. Am I right? So let us calculate fair value of C8. So I will straight away jump to C8's fair value. Before that, let us write the peg value. Before that, debt to equity ratio, and before that, after that, interest coverage ratio, and price to book value. So come on now, quickly tell me the values of this price to book value, that is PB ratio is how much? 2.04. Okay. How much is debt to equity ratio there? 0.33 something, I think. Interest coverage ratio is around 7 point something. Am I right? How much is debt to equity? Debt to equity is 0.33. Interest coverage is this. PEG is 0.21 something, I think. Wait, let me see. PEG value is PEG ratio is 1.15, 0.53. PEG ratio 0.15. Okay, interest coverage ratio 7.53. Debt to equity 0.33. Okay, so we need to find yearly percent growth of EPS in last 3 years. Am I right? How much it is? Go to the annual results. Is my voice clear to you? Okay, so 110.11 minus 30.38. Am I right? 110.11 minus 30.38 divided by 3. Yeah, that divided by 3, and that, yeah, 26.57, and that ratio divided by the stock PE. It is 2.297. Am I right? Am I right? Now to calculate fair value multiplier, what you will do is 2.29 divided by, what is the PE? 11.57, right? So it is coming how much? So the fair value of stock is fair value multiplier into current market price. This is how much? How much it is coming? What is the current market price of C8? Here it is 1153.90. Are you there? Can you hear? Kindly respond. 1153.90. Okay. 1153.90. So how much this is coming? It is coming around 228. No, it is not 1137. It is 228.386. So it is an expensive stock or an inexpensive stock. Is it undervalued or overvalued for now? Yeah, it is undervalued or overvalued for now. It is no. Expected fair market price is 228, and what is the price right now? How it is same, Arvindji? The price is 229 expected price. Expected price, fair value price is 229. The market price is at 1153. Yeah, don't get confused. So it is highly overvalued for now. So shall we buy this stock or we will not buy this stock? Fundamental analysis and even technical analysis, I can see as per this chart, line chart, we have a shorting opportunity in C8. The ideal value of C8 is somewhere around here. So now during a market crash, if you see the stock below this 200 and some this level, you can jump in and buy this stock. So this is a stock which we will reject, and see this profit growth 9.88. So there might be some issue. Let me see that also. See, if you see this, na promoter stake has decreased. इसका मतलब this means that the total shareholding of the promoter he has given to someone else for some amount. He has sold his positions, little positions, to someone else. So would you like to invest in a company whose promoter itself has sold many of his shares to someone else? No. Either it could be promoter stake has decreased, either this could be sold to someone or he might have pledged some amount. Okay. So overall what we can use this is, yeah, this is a good fundamental company but price is slightly high. We can use C8 for swing trading and small term tradings to go into buy. Okay, to buy these stocks. Now let us see Hindustan Zinc Limited. Current price 284. Shall we see this stock or shall we stop here itself? See, look at this, interest coverage ratio is very good of this company, 43.56. PEG ratio is normal. Okay, you practice it. Peg ratio is normal. So this current market price divided by peg ratio, how much it is coming? 284.15 divided by 1.62. How much it is coming? 284.15 divided by 1.64 is coming around 175. Am I right? This is coming around 175. Am I right? So you do one thing, you go through this total fundamental analysis and hope you have made the note. These videos will be available for you in the websites from, I think, from tomorrow. Yeah, 175. So this will be available in your website for from tomorrow, I think. And these fundamental analysis will help you in rejecting stocks whenever you are looking for a long-term perspective. Yeah, I will send you the details. You need to register and make an account, and then you will be able to see the videos. Any PW means? No, no. Have you registered in my website? I think you just made the payment. You have not registered, I think. So you have registered. So you might have set the password, right? You check again. You will get a link tomorrow. Tomorrow you will get updated and practice this fundamental analysis thing. Next we will go into the, again this is a very good stock. Kitex Garments, do practice this. Okay. So the con side they have not updated. Company good consistent profit, and the expected growth is P is 18.05. What is the OPM? Let us look. OPM is very good, 32.51. So if you calculate last 3 years EPS, let us do quickly calculate fair value of this. 23.29 minus 6.05 divided by 3. Yeah, divided by 3 and PE value. So what 1 second, how we are getting 5.24? Okay, that divided by the PE will give you the fair value multiplier, that is 0.31. Okay, so it is highly above the normal price. It should be around 133, the fair value of this stock. So as you can see, it has gone very up in recent time. Can you see this? So now it is slowly coming down. So as it comes to the low level more, we would be interested in seeing the stock as per fundamental analysis. Is that clear? Rest everything is good in this. I think book value, see here itself, current price and book value, what was the ratio of book value? Price to book ratio, what was that? It is around 4.6 something. So it is generally normal, it is not undervalued for now. Is this clear to you, fundamental analysis, Arvindji? Okay. So we will stop with this, Arvindji, and the next class I will initiate you when we are going to more so with practice. Okay, I didn't read your previous message. What was that? Okay, okay, fine. Yeah, do practice it, and it is good way to reject stocks. From tomorrow, we will enter into technical analysis part one by one. That will be more interesting, and even it is more interesting for me to take all those things. Yeah, next class we will have tomorrow. Sorry, right at 4 o'clock, 4 in the evening. That is fine, right? Okay, just hold on. Let me stop this recording. You're on. And thanks again to attend my class. Thanks to visit Stock Wizards.